First, I want you to say hi to our audience, Mark.
Hi, good afternoon to you. Happy to be here.
Mark, we are very pleased to have you, and I have Vanessa Xu with us as well, who is the CIO and founding partner of VS Partners, and which is a Hong Kong-based global asset manager. And before VS Partners, Vanessa founded a Greater China long-only fund in Hong Kong, and before setting up her own shop, she was an investment officer of Capital Group's emerging market PE. So we are thrilled to have you both in the program, and both of you are very insightful and have a deep commitment to do well by doing good. And hopefully we'll bring about some interesting discussion today. Mark, let's start with you. So I want to get to one of the most important problems we are facing, inflation in the US and Europe, and Fed's tightening pace. So usually when the Fed started its tightening cycle, it will continue to hike until something breaks. You started your career as an economist. So how does the current tightening cycle of the Federal Reserve differ from previous ones? And what kind of economic slowdown will cause the Federal Reserve to pause?
Right, well, good question. And I think if you talk about, let's say, comparing this cycle with the previous ones in the past, I think if you look to where the inflation numbers are currently, almost double digit, that has more similarities, I think, with the late 60s, early 1970s rate hike cycle, more than the 80s and later on, because inflation at that time, later in the 80s, was clearly lower than we are currently witnessing. So in that sense, that looks similar. I think what is also very interesting to see, and that's maybe different than we've seen in the past, is that the Fed is moving pretty much faster than since 1994 than we've seen in any cycle. We've seen 275 basis point hikes back to back. And I said, since 94, we have not seen such a fast pace. So it's clear that the Fed is moving on a faster pace than in previous cycles. If you talk about similarities, probably what comes to mind is the 2017, 2018 hiking cycle at that time by the Fed, where the Fed also had to do with both interest rate policy as well as the balance sheet of the Fed at that time. So I would say those 3 points I would make as a comparison to previous cycles. On your other question, in terms of what slowdown is needed, I think the short answer would be a recession. Historical evidence has shown that any recession brings down inflation to the targeted rate which they are aiming for. However, that said, I think the Fed also has a dual mandate. It's not only looking into inflation, it is also needing to balance the labor market in that respect. And here comes the most difficult part, because the labor market is very much a lagging indicator. So they need to look at other statistics, more faster statistics than only the labor market. So looking to housing market stats, looking to ISM and new orders data, I think that's going to be important for the next couple of months to get a glimpse on what they're aiming for. And history has also shown that the moment the ISM, for example, is below 50, they will not hike anymore. So it's very much also looking into when the ISM would drop below 50, and in our take, that may take a while, but maybe somewhere in Q4, that may maybe stop the Fed in hiking, or at least take a pause at some point. In general, I would say, and that's not only the Fed, but also I think more central banks. It's clear that central banks are getting much more hawkish in terms of making sure inflation is not going to be a lasting problem, and that they're giving up in preventing growth, but really want to make sure that second round effects of inflation will kept at bay. And I think that is the priority now for most central banks throughout the globe.
What about the 2-year treasury note? The capital market pays lots of attention to this financial tool. Do you think it concerns the Federal Reserve at all?
Sorry, the 2-year note, you mean?
Yes.
You mean that we have this inverse curve now in the US? Well, yeah, I don't know whether that is really something of a big concern to them yet. I think, and also the reactions yesterday when I read after the CPI number in the US, where inflation was clearly positive, or at least better than expected. The Fed was clearly on a tone of, one print doesn't make us more at ease. So I think they will remain focused on really getting inflation back to the targeted level in the long-term time span. That can be at the cost of indeed higher rates. So 2-year notes are clearly higher than 10 years at this stage. So we still have an inverse curve. But I think for the Fed, that is now priority, as said before, even thinking about growth, getting inflation back into a target where it doesn't spill over into second round effects. I think that's going to be crucial.
Okay, that's quite helpful. Vanessa, the PBOC is easing while major Western central banks are tightening. So what does the variance mean for the market?
First of all, I wanted to clarify that the PBOC easing is a overly simplified notion, or the expectations by the market participants. But I would rather to say that the Chinese monetary policy is accommodative, but not loose, but not very loose. Being the macro constraint is that the deleveraging efforts in the macro economy is very much still the target of the central government by transiting the nation's economic development model from fixed asset investment driven to domestic consumption driven, right? So that is a macro target to stay on. Therefore, the monetary policy cannot be too loose as to run into another round of asset prices bubble. So that having being said, I think globally we moved from a macro regime of synchronized central bank policies to decentralized or dispersion in central bank policies, and we see the different paces of hiking. The emerging markets had to hike much earlier than the developed market, which and ECB and the Japanese central bank has very different operations from the Fed. China is different from all the developed economies on the relatively accommodative monetary policy. What it meant for asset allocators is that it creates truly discorrelated asset classes for us to construct a portfolio that help to balance different macro cycles. So, for example, the last year when the expectation of hiking started, and the second half to the first half of this year, broadly speaking, in the global bond market, it was not a pretty picture, but the local currency denominated Chinese bond market, not the offshore bond market that was dominated by the real estate credit, but the local credit has offered perhaps is the most underowned, underappreciated asset class, which is very large and offered discorrelation to literally every global asset class, with a negative correlation and a positive absolute and relative return. So that's just an example of what the dispersion of global macro cycle means for allocators.
Okay, so you brought up a very interesting point. Do you think investors in China has priced in too much accommodation from PBOC?
I tend to think so. People expected too much, I would say, of PBOC accommodating, and the market was underwhelmed in the first quarter. And I think really in terms of the China market, be aware of the macro risks from the deleveraging from the credit sector is very important. And in terms of equity, really to look at after de-risk in the first half, really to look at earnings power and the fundamentals of the equities. There's a huge dispersion as well in the equity space. So counting on the liquidity flood to to float valuation, I think that's unrealistic.
Okay, that's very illuminating. Mark, the bond market in the United States has priced in a pause from the Federal Reserve in the near future. I was wondering what will happen if the pause actually turned out to be way later than the market has anticipated.
Yeah, I think that is a clear risk, I would say, and in particular, if you look to the recent price action we've seen over the past couple of 6 to 8 weeks, and also yesterday in global equity markets, where there's a huge hope that inflation will drop, and I think everyone agrees to it, that we have seen the peak in inflation, in particular probably in the US. So markets are running ahead on that the extreme tightening they were expecting at the beginning of the year, that it will not be that substantial, and therefore that gives some relief to, in particular, I would say, the interest rate sensitive stocks like growth stocks, and that leads to the clear, rally we've seen in equities in the US and Europe as well over the past couple of weeks. So, getting back to your question, the moment it turns out to be that this pause will take longer, I think then equity markets can still be at risk for the simple reason that there's now too much optimism, maybe priced in purely based on one or two, somewhat better than expected numbers. So that is, I would say, some sort of a risk to equity markets from current levels where we are.
So let's delve deeper into this question. What caused the anticipation? Because like nowadays people are lack of credibility of the Federal Reserve because we don't think Jerome Powell will turn out to be Paul Volcker in as determinative as Paul Volcker. Wait, do you think is that a reason that caused the market anticipation?
Well, I think it more has to do with the fact that people indeed believe that the peak of inflation will be there. And don't forget, a lot of the bad news was already priced in during the first quarter of the year. 9, 10 rate hikes were priced in, where we were coming from 12 months ago for only 4 rate hikes or so. So I think the market initially was extremely negative and now became positive. My personal take would be that I think if you read well through the Fed over the past couple of months, that they agreed upon the fact that they were mistaken initially in saying inflationary pressures are temporary. And I think by being very open to that and saying, okay, we were too optimistic that inflation would turn down quickly, that they have regained a lot of credibility as well. And I think, as said earlier, the statements yesterday from some Fed members also show that it is really serious for them to get inflation back into a much more controllable way. So if that's going to happen, I think then markets will get some relief. But if that's not going to happen, and indeed you have a more persistent negative inflation number, I think then markets will be at risk, because I don't think that the Fed will be too loose in that respect. Inflation targeting now for them, getting it down, I think is really a crucial point. So in that sense, maybe it's not Paul Volcker like the 80s, but it's clear that they will not stop hiking unless they are clearly certain on the fact that inflation will come down.
Okay, that's very helpful. Vanessa, we are talking about independence of the China market. Do you think if something break in the US, so how will the risks spill over to China market?
Before I answer that, I just wanted to, supplement what Mark responded to the previous question. One critical difference between the 80s or 70s versus today is that in the 80s, the world was not even nearly indebted as we are today. And Paul Volcker had a condition when he was trying to arrest that hyperinflation. He could hike the interest rate to be above the nominal inflation rate, but because the economy wasn't this much indebted. But today we didn't have that condition, and also the dollar, particularly the euro dollar system, in terms of providing the world with the liquidity, wasn't as important, wasn't as dominant as back then. So if the dollar interest rate hike too much and tighten too much, that would not only be a problem for the US, but it would be a problem for the rest of the world. So these are the two critical differences of today, which relates to the answer to your question to me whether China is truly independent to the rest of the world as a quote unquote safe haven, as many of the domestic media would call it. And the simple answer is no. China is not independent of the rest of the world. Not from the fundamental side, the economy is so, intertwined in every industry to the rest of the world. And in terms of the macro cycle, liquidity and interest rate, China, by and large, 60% of the reserve is pegged to denominated in dollar. Therefore, the dollar cycle, of course, they have a tightening cycle. Of course, it has a tightening effect on the ability of money supply in China's macro system. Therefore, Chinese market is not independent from the world system. But if there is a technical accident in the U.S. that something breaks, for example, some accident in the credit market or the financial system plumbing, that could trigger a flash of volatility. That scenario would have limited impact on the domestic market. First of all, and secondly, China market is a big notion, and we need to separate the Asia market and the Hong Kong or the overseas ADRs market. For the question you ask, that is liquidity driven. I think Hong Kong would be more susceptible to global liquidity risks than the domestic market, which by and large the liquidity is supplied by the domestic forces.
Okay, that's very helpful. So we live in an integrated world. If U.S. market or U.S. stock market crashes, and I think a lot of us can get out happy. Okay, so we talked a lot about liquidity. Let's get to earnings. Mark, do you think the U.S. market has priced in enough earning dumping at this point?
Good question. I think normally when you go into tightening monetary policy cycles, that also leads to reduction in earnings forecasts. So far, indeed, we haven't seen that materializing. And to some extent, I think earnings and earnings forecasts have held up and were pretty much more resilient than we initially thought in the first half of this year and also in Q2 of this year. So in that sense, that is in a way logic, as you see that we are coming back out of this pandemic, a huge amount of additional saving. If you're here in Europe, I just had my summer holidays, you see a huge amount of traveling. There's a lot of pent-up demand. So that is a sort of a caution to companies, to earnings, to the economy in general. But I think going forward, I think the risk is when if this will continue. And therefore, we are less optimistic going forward in the second half of the year in terms of whether this earnings momentum will remain there. And I think if you look to the inflation background, the Ukraine war, still the problems on the logistic and the supply chain disruptions, we do think that we will see some more reductions in negative surprises in earnings forecasts. So that makes us a bit more hesitant going forward in terms of the earnings forecasts.
That's kind of related to the style shift, the growth toward value shift, which is happening in the last, starting in 2021 in global market. Do you think it will sustain given what you just said?
Well, that's also a very critical and difficult question. I mean, let's start with anyway with value investing. I mean, it's hard to be against value investing, right? But at the same time, we've seen over the past couple of years that value has a huge amount of problems versus growth stocks. The last decade, in that sense, was telling, I would say. But clearly, we've seen a huge rotation in the past 12 months. And I think the big driver here has, of course, been the monetary cycle, the change in interest rates, and in particular, where growth stocks are more, I would say, interest sensitive, sort of long duration stocks. They were clearly hurt over the past couple of months. I also think there was a huge overcrowded position in growth stocks in that sense. So looking for the very short term, I do think that at some point this rotation, which we already seen in the past couple of weeks, will stop a bit. But from a historical and valuation perspective, I do think, and given the economic background we're in, that it's not over yet, that value stocks can continue its run. Having said that, it's also, I think, the past couple of years were, in my experience and in my analysis, were more the exception rather than the rule. So looking forward a bit longer, I do not expect that growth and value will be that dispersed as we've seen in the past couple of years. So I think it will be closer together moving forward, and the exceptions we've seen are not the norm. So in that sense, it will get closer to each other. But for now, given, I would say, the background we're in, value may be still best positioned, I would say, moving forward. Finally, in that respect, if you would have a market which really, or an economy which turns into a recession, of course, then history also shows that also value stocks may have more difficulty, yeah, it is quite an interesting balance in that respect going forward, and depending very much on your view on what interest rates are going to do in determining if value or growth will outperform.
Okay, so we are having increasing uncertainties in this picture. And the other question is about Europe, and I still want to put this question to you, Mark. And Europe is having a perfect storm. So is Europe still investable? And where do you want to put your money in Europe?
Well, I think Europe is indeed still investable, right? It's of course it's clear that if you look at it from a macro perspective, there are many clouds hanging over us, so to speak. And obviously, it's the well-known facts we know currently. I think inflation is clearly a problem, certainly in some European countries. The country I'm living in, for example, it's a really hot topic the last few weeks. The energy crisis is clearly suffering or hurting the European economy. And also we have this whole big debate on or the difficulty for a central bank needing to hike rates to contain inflation, while at the same time we have this potential political instability in the European periphery. So that makes it a very difficult task to balance. So if you look at it purely from a macro perspective, from a sort of a helicopter view, it's easy to become negative about Europe and be cautious in that respect. At the same time, I think if you look at it from a bottom-up perspective, our teams are clearly still finding high-quality companies in Europe which have pricing power, which can generate cash flows, and we find those companies in sector like healthcare, energy, or financials. So it's a long answer to your question. Indeed, I think it is still investable. The macro backdrop doesn't look fantastic with the well-known issues surrounding it. But from a bottom-up perspective, as said, we do think there are still very high-quality, internationally exposed companies to be found in Europe.
Okay, quite interesting. Probably becoming even more selective in terms of allocating to Europe. So let's get to China. Vanessa, China market did quite well in Q2 and outperformed lots of major markets. So first, what do you think has driven the outperformance?
Well, as we discussed just now, I think the macro dispersion and the industrial space and the export space of the economic resilience that has supported the relative performance of the market. But going forward, I think we need to be highly aware or not to underestimate the first degree, second degree, third degree impact from the credit risks in the real estate space and upstream, downstream, and the impact on the consumer confidences, and also the wealth effect impact on the consumption and the loss of that property sales revenue for the local government, and therefore to make further investment and create job opportunities. So these are the chain effect of that slowdown or the transition of the development model that we need to watch out for and not to be highly aware. That being said, in terms of the earnings questions that you ask, we will see very big dispersion. Really, it's a bottom-up pickers market. both in equities and credit in China. It's not going to be single-sided Goldilocks period of time, even with the central government's relative fiscal and monetary accommodation. So that's the short comment on China. And also to your question of value growth rotation, we see several rotations over the last 12 months in different growth sectors, new energy, particularly in the EV space, in the battery space, etc. So we tend not to simplistically divide the market in such a binary way. It's a new or old economy, or value versus growth. As Mark rightly pointed out, the line will become more blurred, and I think directionally over the next decade, the market leadership is very likely to be balance sheet strong, industrial, capex light, cash flow generative, dividend strong, cash flow yield strong type of companies in the real economy, rather than the last decade, which was by and large capital light, very grossy internet company. If not a replacement of the market leadership, at least the market will not only led by a small handful of internet companies. I think investors needs to get off of that past dependence of still going back to a small handful of internet names. And for example, for us, we very much focus on the latter one, which is to go back to the real economy, because capital is no longer free, because perhaps in global inflation is going to be persistent, if not 8%, and 3 to 5% in the foreseeable future. Therefore, capital needs to generate a real the requirement on IRR to be generated on the capital will be much higher. Therefore, for balance sheet strong, capex light industrial companies that can generate a strong cash flow will have the strongest capabilities to enhance shareholders' value going forward.
Okay, you just mentioned the internet companies, and we talked about the real estate sector. And is there any other sector you want investors to be cautious in the next 6 or 12 months?
Anything that's a hype. There's this notion of thematic investment in the domestic market, which to me is just a phenomenon of crowding in a fast speed. So whenever there's a crowding in a very fast speed, as to liquidity just go on, this consensus gets formed so quickly on so few handful of names, and the valuation just go through the roof. Those are the areas to get away from.
Okay, that's a very good advice. So next, let's shift gears, get to long-term picture. And it is said that the capital market has predicted 9 out of the 5 recessions previously. But I think the market has actually predicted more long-term trends than there actually occurred. So I want to pose the question to you guys. So what do you think are the 4 types the market was mistaken for long-term trends in the previous probably 3 to 5 years? Mark, shall we start with you?
Yes, well, as you say rightfully, I think stock market has predicted 9 out of 5 recessions, and in that sense, I fully agree with you. And to be honest, when I started my career, I worked as a bond researcher in the early days, to be honest. And my experience in that respect is also, I think that bond markets are sometimes much better in predicting turning points in economies, for example. I think if you look back to 2007, where equity markets were making, I think it was October 2007, made a new high. When afterwards we got a recession officially by the NEBR announced, and the same is true in March 2000, when stock markets also went to really a top in the market, and then also the economy clearly fell into a recession. So equity markets, I think, are sometimes overly optimistic, and as Vanessa said, they tend to move in high growth hypes or so, and I think that's what you basically see quite a lot, I would say, in equity markets. And these are the moments, and these are the most difficult moments to really tell yourself, okay, do I want to be in or not? And these then tend to create those false hypes. And I think we've seen it also in the past couple of years when everyone was moving into those crowded places. As Vanessa said, only a few small internet names were there. So the leadership in the market was only determined by a small amount of names. And I think these are always the false hypes we see. It's a bit of a behavioral bias probably in the investor minds. If you talk about what are the true long-term trends, I think that is sometimes very interesting to think about, because in our view, those are sometimes the most easy predictable ones, and also sometimes the most persistent ones. And the way we look at it within our firm is trying to define what are true long-term trends. Like, for example, I think that's, of course, everyone knows, but the whole, transforming technology thing, it's going on for many, many years. The thing is, how do you play it? How do you get exposure to it? And how much courage do you have to stick to your belief in that? Another one, which is very predictable and everyone knows it's there, that's, I think, on demographics, where you see an upcoming middle class in many countries. So finding companies with exposure to those kind of trends, I think, is a great way of investing. But again, it is, you need to have the patience and the courage to withstand the volatility if you believe in that trend. And I would say a third one, which I think is also a clear trend, I would say, in particular in Europe, is the whole thing which we are seeing to change in terms of sustainability, climate, etc. There, I think the social awareness, the change we see in that respect, but also the combination with tighter regulation, that leads to a real long-term trend in our belief that sustainability will be there to stay and even will increase. As said, regulation will push us in that area. The societal awareness will help us in that area. So that's also something I think we should not underestimate, and that is a trend which will continue to be here. And as an investor, it is the challenge to find companies who have exposure to those kind of trends and who have solutions which help you to get the returns which are linked to those long-term trends. So that's I would say that the three big long-term trends which we are looking for.
That's very interesting, and I think so. You make me feel much better, because I'm always driven by the anxiety of missing out the true long-term trend. But it seems that the truly long-term trend, which will sustain for decades, probably even longer, is the most evident, the most apparent one. Well, yeah, that's very interesting.
It is that, yeah. But as said, it's easier said than done in terms of how do you monetize it. And monetizing those trends is, of course, the most difficult part. It's getting rid of the hype phase. It's getting into it in the monetizing phase, and that you can really capitalize on it. It should also be investable. But if you really take a big step backwards and think about it, then these kind of trends are really there to stay. And indeed, the trick is finding the companies who benefit from it.
Vanessa, what are the truly important long-term trends to you, and how should investors position for these trends?
Well, I totally agree with what Mark said. The sustainability, this is a big word, but it's also a word that means the world. And sustainability and energy transformation does not only mean EV cars, right? That's the hype part. Perhaps it's a hype part of it in terms of the industrial competitiveness, and it's a highly competitive market that it's very difficult for any company to make sustainable margin in that part of the market. However, sustainability also means, first of all, in order to transit from fossil fuel to to new energy, that we need to make sure before we get to point B that the conventional energy supply can sustain our industrial and civilization without too simplified to assume that sustainability means the world without fossil fuel. However, there are climate and clean technologies to make the production and exploration of conventional energy cleaner, more efficient, and reduce the carbon emissions. So those are the technologies that transform energy on the supply side, and while maintaining sustainable energy supply. Even when we reach net zero in a couple of decades, fossil fuel energy is still going to be a very big part of the energy supply. They're not going to disappear. So we need to, instead of just shun away from it, we need to look at the sustainability technologies and the processes and the new materials to help that part of the transition on the supply side. That's a huge $1 trillion opportunity. And on the demand side, we cannot just jump to alternative energy all of the sudden overnight. We need to build infrastructure. We need to build the demand processes and enablers, the hardwares and the softwares, before alternative energy can really take a bigger part of it. For example, the power transmission systems, the charging systems, right, and the terminals to receive natural gas in the case of Europe. So on the demand side, there are a lot of infrastructure that needs to be in place before people can actually move their energy consumption behavior from traditional energy to new energy. So that, again, on the demand side, is another huge $1 trillion opportunity that if we just take this buzzword and peel through the onions, and we'll see very exciting opportunities that merge the old and new together. And that is a sustainable and practical trend. Another buzzword I wanted to point out is, I don't know why, but the word uninvestable is very popular right now. You just ask the question to Europe, or 6 months ago, that was the buzzword for China. And whenever there is a macro risk, there's a geopolitical risk, there is a structural economic transition, people use the word uninvestable. I think that's overcooked. Right, and taking China as an example, yes, we do not overlook the significant geopolitical confrontations, the change in the world order, and the transition of the domestic development model, as we just discussed. However, just one, on the industrial side, I just give one example why that's perhaps a false hype, is that given where we are in the global monetary and interest rate cycle, at the end of a 40-year long the interest rate dropping cycle, and there is no other emerging markets that can, at such a capital cost in dollar term, to build domestic infrastructure at the scale and at the efficiency of what China did, financed by domestic credit. If you have to finance your massive infrastructure build out by dollar debt, that is going to be very problematic. Therefore, without that infrastructure, without that efficiency, you cannot build in a short period of time of the industrial manufacturing capabilities as what had been built in China over the last 20 years. So this is just a fact. Therefore, I think the world needs to work together on the supply chain issues rather than to overly simplify it to the other extreme as if everybody is aware of the Chinese capacity and the China becomes uninvestable and everything moves to Southeast Asia. The real world doesn't work like that. I think the financial news wires has simplified the world too much. And we as long-term investors needs to look at what's a fact rather than what's fashionable.
Okay, I admit we news media tend to think in binary. Okay, so I think both of you has pointed out one very interesting point, that is, even though these long-term trends are apparent, but the evolutionary road is not linear. So there are lots of things to learn and to understand how it will unfold. And I kind of exhausted my questions. So do you each have questions for the other? Mark, do you have questions for Vanessa?
Yeah, one of the things which comes to my mind is I traveled a lot in my early career in the 90s in Asia. And I remember that well when I've been visiting Beijing and many countries in that area. And I remember at that time I was an economist and I was talking about the European Union, which at that time was not there yet. But I encountered quite a lot of skepticism at that time, which I fully understood because I was a European living in the Netherlands with a central bank linking its currency to the Bundesbank at that time. Well, moving fast forward, we have this European Union now for over 20 years. We have one currency. I was wondering how, and I still look positively to it, but as I said, I'm looking through a European lens or even a Dutch lens. I was wondering, Vanessa, how do you look at the European part of, or the European project and the stability of the euro from an Asian lens? How do you view that?
I think the trade is more dispersed and energy consumption is dispersed, manufacturing is dispersed. The world is much better off with a more balanced reserve and trade currency system there. And this time, I think the reaction to the pandemic relief 2 years ago by the European Central Bank to go one step further to the fiscal union is a progress. I think in a euro debt crisis a decade ago, the biggest doubt about euro sustainability was a lack of fiscal union, and this time is one step further and one big step further. Asia and Europe, by and large, are very big trade partners. So a evenly distributed, more diverse global currency system is a lot more healthy. Otherwise, a very overly strong dollar and overly tightening dollar liquidity is bad for the world economy. So that's my 2 cents from the. I'm not sure if that's the Asia view. That's a Vanessa view.
No, but it's very informative. Thank you so much.
Okay, Vanessa, your question for Mark.
Okay, so my question would be: given your long distinguished career globally, what could be the biggest unknowns that we as professionals in a market have not imagined enough, have not prepared for ourselves enough?
Yeah, that is, of course, the big question, right? Every time when we heading into a question and we run into this question ourselves. I mean, I'm also a member of the Risk Management Committee. I'm chairing that here in Robeco. And then we asked ourselves this question. And I remember recently when the whole cryptocurrency business really was collapsing a few months ago. I also raised the question, do we miss something? Could there be some sort of a spillover effect which will hurt somewhere the financial system and so the real economy? It didn't materialize yet, but to me it feels, but that's a personal view, it feels a bit uncertain in the sense that there's so many billions of money. It is out of our system, or it is in a cryptocurrency world where, and I may be too old to understand it fully, but to me it feels like I have no valuation behind it. What is it? but there is a huge amount of money flowing into the system, and then everything collapses. Companies are around it, and is that an unknown, which may really hurt us at some point in time? That is my quick answer, which comes to my mind if you ask me this question, in saying, okay, where can we be surprised, right? Because it is really an unknown, because we have never dealt with it, right? I think we dealt with the Asian crisis in the 90s. We dealt with the European debt crisis in 2013, the global financial crisis in 2007, and we always have adapted. We have always have new regulation, new way of risk management systems and matrices. But this one is, to me, at least, it's pretty new, and I don't think a lot of people understand it, and also how it filters through into a real economy. And that is, a bit of a risk I see.
Okay, that's what we have for this session, and I have like 5 minutes left. So let's get to the last session, quick questions. I will present a few quick questions, and you answer with punchy short answers. Shall we start now? Okay. So what is your safe haven for 2022, Mark?
Yeah, the most easy part, if I really take a short horizon until the end of this year, right, I would say probably cash from an equity perspective. I do think that there's still a bit of a risk going out in the next few months. So cash would be probably an interesting one. Although I also got convinced by Vanessa's story about the independence of, for example, the Chinese bond market, which really is a diversifier and has clearly high yields. But if I really need to take a bet now for a short-term period, I would say probably to be in cash now.
Okay, Vanessa.
Long volatility. Long volatility.
Okay. So tell us one lesson you learned that you wish you knew a lot earlier, Vanessa.
Have more imagination on the change to the negative side.
Okay. Mark?
Well, my lesson would be that bond yields can go lower for much longer than you expect. That's Ireland.
Okay. Okay. We all want to travel back in time and to predict the future.
Exactly. Yeah.
Okay. List the 2 people, living or dead, you wish you could meet for dinner. Mark?
Yeah, I'm a sports fan, so I would love to have dinner with Roger Federer, to be honest. I was doubting with the former famous footballer Johan Cruyff, the Dutch famous football player, but he died. And a second one, and that's a bit different, I would love to have dinner in 18 years' time with my to-be-born grandchild. I'll get a grandson in a few months' time, my first grandson. And I'm wondering how he would look back when the year 2040 in this period. So it's a future dinner I would propose with my first grandson.
Okay. So living or dead, you wish you could have dinner with?
Stan Druckenmiller.
Wow.
Yeah. I very much admire his mind of that variation process of completely have no past dependence, that he can change his decision from left to right in a second, and completely factor-based, and such intellectual humility to admit that something else has happened. The fact emerges that he is wrong, and they have no problem to admit to that. I very much admire that intellectual superiority.
Okay, indeed, it's very remarkable to see the list from Druckenmiller. So top themes to watch in China market for the next decade, Mark.
I think, and Vanessa already touched upon it, but it's the industrial upgrade and technology innovation, which is, I think, a huge thing for China, and also looking for 2060. I would say the carbon neutrality pledge which China has signed, which may lead to getting away from non-fossil, but that will take a long time, as Vanessa already explained. But I think these are 2 top themes for China, I think.
Vanessa, what's your top themes to watch?
Demographics. the aging, everybody knows that, demographic challenge in China of an aging population, but I think we need to pay a lot more attention to the social safety networks construction, healthcare network construction, and the caring system, and also to refocus the technological innovation to service and uplift the aging society to counter as the counterforce of that reduction of productivity, which is not only a challenge to China. I think it's a challenge in totality to the world.
Okay, so that's very informative, and that is what we have for today. I want to thank you both for your time. It's very interesting, and I enjoyed the conversation a lot. I hope you too, and I wish you have a good of the rest of your day.
Thank you so much.
Very nice to meet you, Mark. Thank you.
Very nice to meet you, Vanessa. Thank you. Thank you. Bye-bye.
市场波动加大，保持理性分散投资可能才是今年投资的正确姿势。更多投资观点尽在中国基金报的对话栏目，也欢迎关注中国基金报的微信公众号，获取更多节目的文字实录。打开中国基金报的 APP， 关注更多投资视频栏目。感谢您的持续关注，我们下期再见。